Hey, it's Andrew here from Learn How to Trade Online, and I've put together this free Forex beginners course for you. So if you are completely brand new to trading and you have no idea what's going on, this is for you. Now, I'm going to go through some of the very basics to begin with. We're going to take a look at what is Forex, why trade Forex, who trades Forex. We're going to jump into understanding the prices, how markets are priced. From there, we're going to look at bars and candles. Well, look, if I just skip over the page here, you'll see for yourself, this is what we're going to be looking at in this video. So, different trading styles, the 4 stages of trading ability, and towards the end, we're going to look at different time frames, lots and profits, and then at the very end, why 90% of retail traders lose money. Now, if this is a little bit beneath your level, by all means, go and jump ahead and look at some of my other videos, which go into more depth. However, if you are brand new to trading, I highly recommend that you go through this video first before you progress on to any of my other videos. So without further ado, let's get started. So what is Forex? Well, Forex is essentially the worldwide currency market. So we're talking about euros, pounds, dollars, Swiss francs, Japanese yen, Australian dollars, and so on. Okay, now it's the marketplace where you exchange one currency for another. There's thousands of trades constantly every single minute, every single day. And we're not just looking at the big liquid markets like euros and dollars. There's also slightly more obscure and less liquid currencies, looking at things like Russian rubles, Thai baht, Mexican pesos. So the market itself is huge. And in fact, it's 5.3 trillion US dollars per day. And it's one of the largest markets in the world, so it's highly attractive to a lot of people because there's a huge amount of money traded daily, and that a very small amount of that money for you is obviously a large amount of money for you as an individual. Now, it's one of the easiest markets to start trading, and that's because there's a very low capital requirement. So what I mean by that is, if you want to jump in, open an account up and get going, you can start from like a couple of $100. But if you want to start day trading stocks, you might need 25 grand. Okay, depends on where you live. But the point is that Forex has much lower barriers to entry. It's easier to get started. You basically need a few $100s on an account and an internet connection. Now, do not expect to be successful with a few $100s on an account and an internet connection. All right, you obviously need to know more than that because I mentioned to you very early on, 90% lose. Okay. The funny thing is that everyone thinks, but I won't be in the 90%. Let me tell you right now, there's a lot of very smart people in the 90% that lose. Okay. Could be you. Point is that once you know what you're doing, you can make a lot of money from this. Once you know what you are doing. Now, when do people jump into trading Forex thinking they can guess and gamble the way there? And that's not how it works. Now, we profit from the change of prices from one currency against another. There's thousands of people all around the world doing this from home, they're doing this from their cell phones, they're doing it from their laptops, from their desktop computers, and it's a 24-hour day market, 5 days a week. So if you live in Australia, you live in the US, you live in the UK, you live anywhere in the world, you can trade. All right, there's no specific hard open and close like stock markets. With the Forex market, 24 hours a day, 5 days a week. And it is incredibly liquid. A lot of people think, oh, cryptocurrency is great. Honestly, cryptocurrency is shocking to trade. It had its boom days, and cryptocurrency now is in a very tight trading range and it's horrible. Whereas real currencies, they're moving more than ever. Now, who actually trades Forex? Okay, well, obviously I do, and obviously other retail traders like you and me. But who else? Well, we have banks, Goldman Sachs, JP Morgan, Citigroup, Barclays, Bank of America, and so on. You have investment funds, pension funds, hedge funds. There's loads of different investment funds trading the markets. You have governments and central banks. So this isn't, should we say, governments and central banks aren't regularly trading. But they do, some governments do intervene in their currency prices, and central banks, when they're setting interest rates, are actually moving markets. When they give other information as well, central banks are affecting the way that the markets move. There's also multinational corporations, Let's say, for example, that a car manufacturer in Japan wants to open a manufacturing plant in the UK. Well, they've got loads of Japanese yen in Japan, and they want to open up a car factory, a car manufacturing plant in the UK. They are going to need to have some pounds. So they want to exchange their Japanese yen into Great British pounds. On the flip side, let's say that there is a US corporation that wants to move into doing business in Singapore. They're going to need to exchange their US dollars for Singaporean dollars. You see what I'm talking about here with multinationals. Now, alongside all of those others, you've got little old you and me. And retail traders, those of us that trade from home, and some of us like myself that trade for a living, we are a very small percentage of the overall market. So whereas you can take an average of Forex as around $5 to $5.3 trillion a day, retail traders are only around 10% of that. Okay, so we're a very small part of the overall market. The simple fact of the matter is that the banks and the investment funds, they drive the market, and we as retail traders are along for the ride. So if you think of banks and investment funds like cruise liners or massive oil tankers, all right, and you think of little old you and me as being jet skis, that's the kind of comparison. We haven't got the same range that the banks and the investment funds have. We're never going to hold trades for as long as they will. But the flip side is that we're far more maneuverable. Now, the reason for that is because we're trading nowhere near the same level of capital, nowhere near the same amount of money. So as a result, because we're trading less on an individual basis, we can maneuver around the markets far more easily. Whereas large institutions and banks have got so much capital to trade with, they actually need to split their positions and hold trades over a longer period of time. So there's slight differences, but the point is that the institutions drive the market, and we basically have to ride the waves that they create. Now, moving on from there, why should you trade Forex? Okay, so there's been a lot of stuff in recent years as to why the Forex market's the best, or why the stock market's the best, or why you should trade cryptocurrencies. I've been trading Forex now for more than a decade, so I've been around a little bit, and I've traded US stock markets and UK stock markets for a similar period of time, plus commodities as well. I've never really got into the crypto craze. But why should you trade Forex? It's been around for a very long time. It's ridiculously liquid. And the barriers to entry for a lot of people are just so much lower compared to trading commodities and futures markets. It's so much easier to get into Forex when you're first starting out. So I just mentioned a couple of things there. Incredibly liquid. Now, you might be starting off with a small trading account. I'd say anywhere from $500 to $5,000 is a very small account. I'd say you're not even really what I'd consider to be a medium-sized account for a retail trader till you're at least at 25,000. All right. And what's a large account? Well, I still trade in pounds, even though I live in the US. Brexit kind of forced me into that one. But I manage a family fund that's a little bit in excess of, well, currently now we're on 28th of March, and it is currently at 3.8 million sterling. So that's not all mine, it's mine, my dad's, my grandpa's. But point is that that, for me, nice chunk of money, for the market is tiny. It's inconsequential. All right, so what you think is a large amount of money isn't. Okay, you're going to have your views, your thoughts on what a large amount of money actually is completely redefined. Now, there's very low barriers to entry. You can fund an account with as little as $200, but you really shouldn't. In my opinion, you shouldn't fund an account with anything less than $500, because to actually get into trades properly, you're going to need that amount. And to be quite frank, if you can't afford $500 to trade with, then you probably shouldn't be trading. All right, you should only risk money you can afford to lose. And if you can't afford to put $500 in an account, then you really, really shouldn't be trading. Now, you can trade for less than a couple of hours a day. So that's once you're profitable. Okay, so don't think for a second that you'll be trading for less than 2 hours a day to begin with. Okay, so what I would suggest that you do initially is spend a reasonable amount of time in front of the screen looking at charts. Okay, because just looking at charts you'll learn so much from seeing how price moves. Now, don't sit there watching a daily chart where it takes a very long time for things to move. But the point is that you can't really concentrate for much longer than a couple of hours. And that's kind of the extreme. So you want to be at your peak level of focus when you're trading because you're in control of your money. So you don't want to be sitting there for 6 or 8 hours or even 10 hours like a regular day job. You want to be trading for a much shorter period of time at your peak level of focus, get in, make your money, come back again the next day. And once you're profitable, trading for less than 2 hours a day is very realistic. So I live in San Diego, California. I trade for 2 hours in the morning, 6:30 till 8:30 through the US Open, trading Forex plus stock indices and commodities. And at 8:30, apart from half an hour later on, I've finished for the day. And I get to record videos like this. Okay, and it's now what? 11 a.m. All right, but I finished trading this morning at 8:30. So technically my day job is done. Now, the other cool thing with Forex is that there's almost unlimited income. Now, what I mean by that is that obviously there's a limit. So $5.3 trillion a day goes through the markets daily. So technically one person could trade half of that, but no one's got $2.7 trillion a day to put through across every single market. But basically there's a huge amount of volume flowing through the markets. You'll never, ever, ever reach the upper echelons. That's hundreds of billions and trillions of dollars. Okay, so once you're profitable, there's serious room to scale your trading. You can be making an awful lot of money each month, which for you is great, but for the market is a very small amount still, which is really cool. You never want to be the biggest fish in the pond, because if you are the size of some of these massive multinational funds, it's hard to get in and out of the market. Whereas a $100 million fund is tiny. Sounds like a lot, but $100 million is actually nothing to the Forex markets. Okay, so once you can make $100 a day, you can make $1,000 a day. And what I mean by that is, if you can get yourself to the point where you're making, let's say, let's use $100 a day as an example, the only thing that's preventing you from making $1,000 a day is money. Once you're profitable and you're making money, it's just about scaling, having more money behind the trades that you're taking, which is really cool because you can put through thousands of dollars per pip or per price movement. Okay, so once you can get yourself making $50 to $100 a day, you can make $500 to $1,000 a day once you've got more capital in your account. Now, there's different trading styles as well, and in my opinion, for Forex, one works and one doesn't. So there's fundamental analysis and there's technical analysis. And if we look at the fundamental analysis first of all, fundamental traders typically don't look at charts. They look at behind the scenes, they monitor the news. There's a lot of fundamental traders in markets like the stock market, and they're typically long term. Now, there's nothing wrong with fundamentals in stock markets. You can definitely make money with that. But fundamentals in Forex, the hard part's timing it. So I would suggest very strongly that you pay little to no attention to the fundamentals and you focus more on the technicals. Fundamentals tend to cloud your decision-making process, whereas the technicals, you can have specific rules to follow. And technical traders, we're using charts to determine direction, we're using charts to determine where we're going to get into the market, where we're going to get out. You're focusing on repeating patterns. Now, there's obviously that age-old disclaimer of past performance doesn't guarantee future results. But the simple fact of the matter is that what else do we have to work off other than what has happened in the past? We don't. So we have to use past performance, we have to use things that have happened in the past to gauge what is likely to happen in future. And as technical traders, we're short-term traders. So we aren't holding trades for years, we're holding them for maybe only 20 minutes, maybe 2-3 days. Maybe a long-term trade for a short-term trader could be a couple of weeks. Now there's 4 different stages of trading ability. Okay, 4 different stages of trading ability. Now the first one is unconsciously incompetent. Now that basically means you're brand new and you haven't got a clue what you're doing. All right, which means you don't know what you don't know. You're brand new, so you shouldn't know anything yet. Okay, you haven't got a trading plan, and if you are trading, you're losing money. So basically, the first stage here, unconsciously incompetent, basically means you're completely unaware of how the market works. You're unaware of how to trade. You're probably guessing and gambling just off what you think you should be doing. You haven't got a plan in place. Now, the next stage, and it takes people a bit of time to get here, from unconsciously incompetent to consciously incompetent. So now you've been trading for a short period of time, and now you know you're doing some things wrong. You know that you're cutting trades too early, or you know that you are guessing or gambling, or you know that you don't have a proven system. Okay? And while you know that you're doing some things wrong, you haven't corrected them yet. And you're more than likely at this stage jumping from trading system to trading system. And if you're honest, you're probably looking for the Holy Grail. Now, a lot of people fall into this category. You're losing money. You're trying to find something that works. You take 10, 15 trades on one system, jump to the next, jump to the next, jump to the next. And the sad thing is a lot of people can spend years at this stage. All right, so it's a very difficult stage to get from stage 2, consciously incompetent, to becoming a competent, professional, profitable trader. And the biggest difference is up here. You have to learn. You have to understand what's going on. You have to learn proven, scalable systems, and you have to be able to execute them correctly. It's no good having a profitable trading system if you don't follow the rules of that system. So from going from stage 2, consciously incompetent, the next stage is unconsciously competent. So now you are making money, but you're really having to think about it. All right, so you've been trading for a while now. I'm not saying years, but some people do take a very long time going from stage 2 to stage 3. And that's because they try and figure it all out on their own, or they just give up. All right, but to become a profitable trader at this point here, you're probably really struggling with your emotions. So you're seeing trades in profit, you're wanting to close them, but you're really having to pull your hand back and stay in control of your emotions. You have a trading plan, but you deviate a little bit, and you're having to really think about what you're doing every single time. You're making some money, which is great, but you're still really having to think about it. Now, you're feeling good because you've cracked it, but you feel a bit nervous at the same time because you're going, is this for real? Have I actually done this? All right, and you're constantly doubting yourself at the same time, even though you're posting profitable results. Now, from stage 3 to stage 4, there's nothing that I can do to help you get there. Because stage 4 is just unconsciously competent. It just takes time. I don't create traders that get to step 4. I create traders that get to step 3, and they then move from 3 to 4. Nobody can help you go from stage 3 to stage 4. You have to do that part on your own. Once you're profitable, getting to stage 4 where it's just completely second nature, it's just down to experience. There's nothing that I or anyone else can do. You have a plan, you stick to it, you look at charts, you understand exactly what's taking place, you know what's going on, you know what you want to do, you follow your systems, and trading actually becomes boring. At that point, you've truly mastered it. Okay, now again, I take people from stage 1 and 2 to stage 3. I can't get you to 4 for the simple reason I can't control what's in your head and how quickly you become experienced at something. You have to actually do it and gain the experience for yourself from being profitable to then being, okay, it's second nature now. Okay, so where are you right now? If you ask yourself the question, are you unconsciously incompetent or are you consciously incompetent? 90% of you watching this right now are in one of those first 2 stages. You either don't know what you don't know, or you know you're doing something wrong and you're still doing it wrong. The point is, the top 2 there, you're losing money. So if you're losing money, you are either unconsciously incompetent, which is you haven't got a clue, or you could be brand new to trading and you fall into that stage. But if you're losing money, you're one of the first 2. If you're making money, you're one of the bottom 2. And if you're really still having to think about things and it's not second nature yet, then you're consciously competent. And my question would be, why are you watching this video? But thank you. And then finally, unconsciously competent. At the very end there, second nature to you, you know exactly what you're doing. Great. Again, why are you watching this video? This is well beneath you. Okay. So this video is pretty much around those that are in stages 1 and 2. Now, let's have a look at how prices move in the marketplace. So currencies are traded in what's called currency pairs. You can't just trade the US dollar. You can't just trade the euro. Okay? If you're trading a currency, it's one currency compared to another. What's 1 euro worth in US dollars? Or what's 1 euro worth in Japanese yen or in pounds or whatever. Okay? Now, the exchange rate is usually quoted to 5 decimal places. So as an example here, 1.23456. Now, euro dollar is currently underneath those prices, but 1.23456 is a price that euro dollar has been at in the last 3-4 years. Okay. Now, the base currency is the first currency, and then the second one is called the terms currency. And when you're looking at a price like this 1.12345 that you can see on the screen in front of you, okay, these move differently towards the ones at the end. So let's explain this. So the smallest increment of price movement in the Forex markets is commonly referred to as a pip. Okay, so the 4th decimal place for all of the non-Japanese yen-based pairs, the 4th decimal place, so 1, 2, 3, 4, is the pips decimal place. That's the smallest movement. We call it pips. And it's down to price in points. It's just a way of measuring distance. So you're driving along in your car, you measure distance in miles or kilometers. Whereas in the Forex market, we measure distance in pips. It's just, it's a common way of measuring things. Now, there is one step just lower than that, which would be tenths of a pip. Okay, and just like driving in your car, you talk about quarter miles or tenths of a mile. Okay, now you don't say, oh, I live 17 quarters of a mile away from somewhere. You say you live, 17 miles away. Same as you don't say, oh, I'm 1,001 of a pip away. All right, pips is the unit of measurement. Tenths of a pip breaks it down into a smaller unit. Okay, and then we have, going to the left here, tens of pips, hundreds of pips, thousands of pips, and tens of thousands of pips. Now, let's just use this. If this number here moves, you get to retire. All right, doesn't move very often, mind you, but if it does, well done you. Typically, what you're going to be looking at when you're trading for yourself, you'll be in trades that are tens of pips and hundreds of pips. At the very extreme, you may get a trade that goes for thousands, but that's very rare. Now, if we're looking at a Japanese yen-based currency pair, so rather than euro dollar, let's say the currency pair now is euro Japanese yen, as an example. So if the Japanese yen's involved, there's only 3 decimal places. Now, with those 3 decimal places, the last number is always tenths of a pip. Then we have pips, tens, hundreds, thousands, and tens of thousands. Okay, and all that's really happened is the decimal place that was here has basically jumped across 2. That's it. Okay, and all the brokers priced on this way. This is the way that the market is priced. It's just something that you need to understand. Okay, so when the chart moves up, so does the base currency. So on this chart here, we see the market moving up. We see this is the price movement overall moving to the upside. So if it starts in the bottom left, moves up towards the top right, it's an upward trend. And that basically means the euro is going up against the US dollar. And if the chart's going down, from the top left down towards the bottom right, that means the euro is getting weaker against the US dollar. Now, whenever you're buying something, just getting some jargon out of the way now, long means buy. So if you're buying something, you're going long a currency pair. If you're selling, you're going short a currency pair. Plenty of people still say buy and sell, but if you ever hear long and short, long is buy, short is sell. Okay, so let's just go in and look at the price now and see what the price looks like. I briefly showed you a chart, but let's understand it in more detail. So these are called OHLC bars: open, high, low, and close. And you can see they're color coded in red or blue, blue or red here. But the point is that they could be any color you like. So on your trading platform, you can choose these colors for yourselves. I've just gone with red and blue. Now, the very top of the bar is the high, and the very bottom of the bar is the low. Pretty straightforward, right? So the very top is the high, the very bottom is the low. Then we have this little knob on the left here. That's the opening price. And here's the little knob on the right. That's your closing price. And when the closing price is above the open, it means that buyers won that bar. They pushed price up. When the close is underneath the open, it means that sellers won. The price got pushed down over that period of time. These bars are moving in real time. So when you're looking at these, this current close is actually the current price that's moving around. But all the historical prices on the chart, obviously, they're fixed in this way. Okay, now if we're looking at candles, which I personally prefer, all that really happens, I'm going to jump backwards and forwards a couple of times here so you can see. Now, open, close. If you join the open and close together, you get a candle. And that's called the body of the candle. So the open, you can see here, the close would be here. And because it's color coded in blue or whatever your bullish candlesticks are colored in, that means that it's a buyer candle, which is bullish. And this is a bearish candle or a seller candle. Okay, and it opens up here, closes down here. All that's happened is that the open and close are joined together to create a candlestick. Now, candlesticks I personally prefer because you can see strength and weakness in the market more based on the size of these bodies of the candles. Okay, again, the very top is the high, the very bottom is the low. That doesn't change at all. And if you're very brand new to trading, just starting out, by all means look at these bars, but it's very likely you'll move on to candlesticks in time. Now, they both show exactly the same information in a slightly different way. It's a personal choice as to which one you use. I use candlesticks. Most people use candlesticks. I suggest that you use candlesticks. Visually, you'll find it just shows you strength and weakness a little bit better. Okay, time frames. So, when you're looking at the chart, how long does that bar or candle last for? Well, these are the different time frames that most people tend to trade. So you've got 1 minute charts, 5 minute charts, 15-minute charts, 30-minute, 1 hour, 4 hour, daily, weekly, monthly. There's other time frames in between there as well. In between 4 hour and daily, you could get a 6 hour, an 8 hour, a 12 hour chart. You could get a 2 hour chart in between here. You could get a 2 or a 3 minute chart. Okay, and you could get a 2-day chart if you wanted to. But these are the common time frames that most people will look at. Now, if we just kind of go through this in a bit more detail, what you'll find is that the smaller time frames, I'd say sub 5 minutes, so 1, 2, 3 minute charts, they're scalping charts. So you're in, you're out very quickly. You're typically looking for less than 10 pips per trade, and you're in, out, you're looking for flow, you're looking for short-term movements, you're scalping. Then you have day trading, which is kind of a step up from scalping. And really that's kind of 5 minutes through to 1 hour charts, I would say. And typically your trades will close out inside of the day. So day trading basically means that you hold your trade for less than 24 hours and you close it out by the end of the trading day. If you're trading anything from 5 minute charts up to 1 hour charts, you're pretty much considered to be a day trader. Now, on the top end of the spectrum, we then have monthly and weekly charts. You won't really look at them at all because it's kind of for investing. If you're a pension fund, that's very important. If you want to get paid in the next 6 months, I wouldn't bother looking at weekly and monthly charts. And kind of one of the major areas that I focus on is swing trading. You've then got daily charts and obviously 4 hour, 8 hour, 12 hour charts as well. But for me, daily charts are the best. They're just the easiest ones to make money on. You get one new candle per day, one new potential trading opportunity per day. It's really easy to fit into your lifestyle. for me, daily charts are my favorite time frame. Now, I trade higher time frames on the bulk of my money and the fund that I run, but I also then trade smaller time frames for income. Because when you're trading daily charts, you have like 21 candles a month. You're not going to make money every single month forevermore. Right? There's going to be a couple of losing months as well when you're swing trading daily charts. So for me, daily chart swing trading is great for growing a pot of money. It's great for longer term wealth. But then if you want to have short term income, then you need to be looking at smaller time frames as well. Now, for me, I look at 5-minute charts. I spent plenty of time on 1-minute charts as well. But 5-minute charts kind of slow things down a little bit and make things a little bit easier. And I don't like going any higher than 5-minute charts because I get impatient. But 5-minute charts for me are very easily tradable. They are harder to trade than daily charts. I certainly wouldn't recommend that you start on 5-minute charts, but if you want to build experience quickly, smaller time frames are a very good way to do that. Just do it at very, very small size or on a demo account to begin with to build experience. Now, this next step now, lots and profits. So when we're looking at the Forex market, we calculate our trading volume, our trade size in lots. So we're trading currencies in units called lots. And a standard lot is 100,000 units of currency. A mini lot's 10,000 units of currency, and a micro lot is 1,000 units of currency. So let's just go back there and write this in. On most trading platforms, the volume for a standard lot is 1.00. The volume for a mini lot is 0.1, and the volume for a micro lot is 0.01. So on every platform that I can think of, pretty much, unless they operate in millions, that's the kind of way that the volumes are worked out. If you're trading in millions, it's slightly different, but I doubt any retail platforms are going to be doing that these days. So if you're looking at trading volume, whatever the volume is, 1.00 is one standard lot. It's 100,000 units of currency. Now, what does that actually mean for you money-wise? Well, it depends on the currency that you're trading. So a standard lot's often shown as 1.00, and on a US dollar pair, this is $10 per pip. So the volume of 1.0 on a euro dollar is $10 a pip, because the dollar is the second part of the currency. However, one standard lot on euro pound is £10 per pip, because the GBP is here. All right, and that's what you need to understand, is that it's not just one standard lot is $10 a pip. So many people say that and they're wrong. All right, one standard lot is not $10 a pip. One standard lot is $10 a pip on a dollar pair. So where the dollar is the second one. If you've got dollar Swiss franc, it's 10 Swiss franc per pip. Okay, it's different on every single currency that you're looking at. All right, so just be aware of that. There are trade sizing calculators out there. I go through that in other videos as well, so by all means check those out. But for now, keeping things really simple, just explaining the basics. So, why do 90% of people lose money? Well, here's the stats. 90% of retail traders lose 90% of their money in 90 days. Yeah, 90% of retail traders lose 90% of their money in 90 days. And in my opinion, that is scary. Okay, so why does that happen? Why do 90% of traders lose 90% of their money in 90 days? Well, there's a couple of reasons. First of all, a lot of people think that they know best. All right, they may have been successful in other areas of their life. They think they can transition straight into trading. You can't. All right, there's a lot of guessers, a lot of gamblers out there. A lot of people that haven't got a plan or haven't even got a trading system. They don't even know if their trading system even works. They're just hoping it works. They haven't put the work in to test it. All right, or they're over trading or over leveraging. So I see these things all the time with people that come to me and they want to learn to trade. And one of the biggest things that I see is they're trading too much, or they're trading too big a size for their account. They might have $1,000 in an account and they're trading like $10 a pip. They're going to wipe their account out this time next week. or a lot of people I see as well haven't even got a proven system, or they've jumped from system to system to system. And to be honest, I say system very loosely. Some of them were just like, well, if it hits this level, I do that, and they haven't really got a rule set. Most people that struggle haven't got a plan. That's one of the big things as well. And a lot of people just guess and gamble and think that that's, a way to trade. And it's not. It really isn't. One of the hardest ways to trade is as a discretionary trader. So where you're having to use your knowledge and predict what's going to happen next. So discretionary traders try to predict the future. And as we all know, predicting the future is very, very difficult. Now, it can be done, but it's very difficult to be consistent. Yet so many people fall into that trap of trying to use support resistance, trend lines, oscillators, and all these other things I'm going to show you in other videos, trying to discretionarily predict what's going to happen next. Now, in my opinion, and over 10 years of live trading, and 8 of which have been profitable, I think that's completely foolish. It's the wrong way to do it. You're basically gambling. Okay, so in my opinion, and certainly the results that I've developed for myself and my students, the easiest way to be a profitable trader is to become a system trader. You develop systems that have an edge. You develop systems that statistically over the long term, based on past performance, will likely produce positive results, so that you know that you have a positive expectancy. And let me tell you right now, designing systems, especially when you're new, is very bloody difficult. I spent years building my systems and tens of thousands of dollars to do it. So let me tell you right now that developing systems is not easy, but it's a lot easier than being a discretionary trader. A lot easier. Okay, now that kind of puts it into perspective as to how difficult this is. Okay, one of the hardest things to do is predict the future. Yeah, that's exactly what every retail trader that comes into the market wants to do. When in fact, the way to actually make money is to build a set of rules that work over the long term and just follow those rules. Now that's when your psychology comes into play of when your system's in a bad patch, you still have to keep following the rules. And that's where psychology comes into play. But being a system trader, let me tell you right now, is by far and away a much easier way to get profitable compared to guessing, gambling, and being a discretionary trader. I gave up on that silly idea 9 years ago and haven't looked back. I only know questionably 2, one for sure, and one that makes tons of money then goes to losing patches. Discretionary traders that are profitable, but he's been doing it for 30 years, 35 now actually. So, it's not easy to be a discretionary trader, and even he actually still uses systems alongside his discretion to smooth out his equity curve, to have more consistency in his trading. All right, and I was very fortunate. I was mentored by 2 30+ year trading veterans to get to the point where I am, and it cost me an awful lot of time and money to really get profitable. It took me 2 years, and people jump into this with 2 weeks on demo accounts and think they can crack it, and that's just not the case. So if you actually want to be a profitable trader, then you have to learn from people that have gone before you and done it. You've heard of the phrase "stand on the shoulders of giants." Well, that's exactly what you need to do. All right. So, if you want to be in the 10% that actually win and are ahead, bearing in mind 90% lose, 10% win. If you want to be in that position, then you need to focus on system trading. You need to make sure that you are trading systems that have been proven over the long term, and you need someone that's gone through and done it beforehand to help you get there. Now, underneath this video right now, you'll see the subscribe button. So if you've enjoyed this video, first of all, give that subscribe button a big old push and make sure you're updated for all of my future videos. But also in the description below, you're going to see several useful links. so you can link back to my channel and see other videos. So I've put together extra training as well, which is not on YouTube. So you can click on that and you'll see it in the description. Takes you through like a 6-part training series, and goes on from there. You'll learn a trading system and so on. So that's really worthwhile checking out. And again, all the links in the description. From here now, your next step really is to click subscribe, then go down and work through some of the extra content that's going to give away some really good stuff for you to be able to use in your own trading. Now, if you're an intermediate level trader or you want to progress on to the next stage, I've put another video together for intermediate level traders, which goes through some of the next level things that you need to look at. And then from there, I've gone and put together another video that's a higher level again. So by all means, go and check them out, look through the channel. You'll see some more stuff. Otherwise, go through the description underneath right now and you will see links that take you through to additional free trainings which are not on YouTube. All right, that's it from me, guys. As always, stay safe in the markets and I'll see you next time.